Imagine a $2.85 trillion Titan.
Right.
I mean, a company that is currently putting up absolute record revenues, utterly dominating its sector. And yet, as of right now, it's trading near 11-month lows at $384.37.
Yeah, it's a massive paradox.
It really is.
Yeah.
So is Microsoft flashing massive sell signals and, just trapping retail investors who think they're getting a deal? Or is this a rare, undervalued, strong buy?
That is the trillion-dollar question right now.
Exactly. Welcome to the Deep Dive. Today is April 14th, 2026, and our mission today is to untangle all these conflicting narratives.
Right. We're digging into the latest financials, insider trading data, Wall Street reports, all the technical charts.
Yeah, trying to figure out exactly what is happening beneath the hood of ticker symbol MSFT.
Ah.
And real quick before we jump in, please like the video, subscribe to our YouTube channel, and honestly, leaving your feedback in the comments is compulsory.
Yeah, we need to know what you think about this.
For sure, to keep the debate going. And just a reminder, this is not financial advice, just raw, natural human debate to help you understand the sources.
Absolutely. Because, I mean, you look at the long-term analyst sentiment, and it remains incredibly bullish.
As a short-term reality is flashing warning signs everywhere.
Literally across the board.
So let's start with the bedrock, right? The actual business performance. Because knowing they made over $100 billion makes this whole stock drop incredibly confusing.
Oh, the contrast is stark. I mean, you look at the current price of $384.37.
Which is up today, right?
Yeah, up a bit today, roughly 3.64%.
Yeah.
But you have to zoom out. It is trading so far below its 52-week high.
Which was what, like $555?
Yep, $555.45 back in July of 2025.
Wow. And it's creeping dangerously close to its 52-week low now, which is $355.67 from April 2025.
Almost exactly a year ago.
Right. But when you place that stock chart next to their actual income statement for fiscal year 2025, it's like the math feels broken.
Completely disconnected.
They showed immense strength. I mean, we are talking total revenue at $281.7 billion.
Which is up 15% year over year.
Exactly. Operating income sat at $128.5 billion, up 17%. And net income was $119.3 billion.
And we can't ignore the crown jewel here, right? Azure.
Oh, yeah. The cloud division.
Their cloud computing division just crossed a $75 billion annual revenue run rate.
That is insane.
Growing at a staggering 34%. Analysts are even projecting fiscal year 2026 earnings per share to increase another 21%.
Up to like $16.50, right?
Exactly.
Okay, wait, I have to push back here. It's like a star athlete who just broke a world record but is somehow losing all their sponsorships.
That's a good way to put it.
If Azure is growing at 34%, pulling in $75 billion, and operating income is up 17%, who is actually selling off this stock right now?
Well,
why is the market punishing a company that is essentially just printing money?
Because, the stock market is a forward-looking mechanism. And right now, it is staring down the barrel of massive capital expenditures.
Okay. Explain that. CapEx, right?
Right. The income statement looks backward at the money they just made. The market is looking forward at the cash they are bleeding to maintain that growth.
Bleeding cash for AI, I'm assuming.
Precisely. To keep Azure growing at 34%, Microsoft is spending billions upon billions of dollars on data centers, on NVIDIA H100 chips, and the energy grids required just to run them all.
So it's basically the cost of the AI arms race?
Yeah, exactly.
But still, I mean, if they have the cash, why does Wall Street care if they reinvest it? They're building for the future.
Think of Microsoft's AI spending like a major airline buying a massive fleet of brand new jets, right?
Okay.
The income statement looks beautiful today because they sold millions of tickets yesterday, but they're bleeding cash today to buy planes that will depreciate over the next few years.
Ah, so it's a depreciation issue.
Yeah, in the tech world, these AI servers and chips have a very short, useful life before they become obsolete.
Right, because the next generation of chips comes out and you have to upgrade.
Exactly. If Microsoft buys billions in servers, that depreciation expense hits their profit margins hard.
Wow.
Investors are terrified that the cost of running these AI data centers is rising way faster than the revenue coming in from the new AI subscriptions.
That brings up a fascinating dynamic because if the fundamental fear is about profit margins shrinking in the future, we need to look at how the market is reacting mechanically in the present, right?
Right.
We need to look at the technical charts to see if this drop is just a temporary dip or a real structural sell-off.
And the technicals paint a very cautious picture right now. The trend direction is decidedly bearish.
Decidedly bearish. Okay.
Yeah, Microsoft is trading well below its 50-day simple moving average, which is around $392.92.
Okay.
And it's miles below its 200-day simple moving average, which sits at $473.56.
Wow, falling below that 200-day moving average feels super significant. Doesn't that usually trigger a lot of algorithmic selling?
Absolutely. The 200-day moving average is like the psychological line in the sand for institutional algorithms.
Right.
When a mega cap stock falls below it, the computers often read that as a shift from a long-term uptrend to a long-term downtrend.
And they just automatically begin trimming exposure,
Exactly.
which creates a ceiling. I mean, we see immediate resistance is heavy between $408 and $410.
Very heavy.
If it somehow breaks that, there is major resistance at $431.
Right.
Meanwhile, the support level is all the way down at $359.84.
Yeah, that's a long way down.
But let me read you the two data points that really threw me when I was looking at the sources.
Okay.
The RSI, the Relative Strength Index over a 14-day period, is at 51.52.
Right.
And the MACD signal, the moving average divergence, is at negative 6.88.
And that combination right there is precisely why so many technical analysts are raising red flags.
Hold on, translate that for a second. If the stock has dropped from $555 down to $384, shouldn't the RSI be flashing oversold?
You would think so.
I mean, people see a 30% discount from the all-time high and just assume the stock is on sale.
And that is the exact psychological trap retail traders fall into.
Ah, the value trap.
Right. Think of the RSI like a rubber band. If it drops to 30 or below, the rubber band is stretched to its absolute limit, meaning the stock is oversold and likely to snap back up.
Makes sense.
But an RSI of 51 is completely neutral. It means the rubber band isn't stretched at all.
Wait, really? So despite dropping nearly $170 a share, the stock isn't actually considered quote-unquote cheap by the momentum indicators?
Not at all. It has plenty of room to keep falling.
Wow.
And when you pair a neutral RSI with a MACD of negative 6.88, which indicates persistent accelerating downward momentum, you get the classic definition of a potential value trap.
Okay, a value trap, meaning the discount is basically an illusion?
Exactly. A value trap happens when a stock looks cheap because it's fallen from its highs, but the drop is justified by deteriorating fundamentals.
Or like a structural offloading of shares.
Yes, retail traders buy in, thinking they are catching a bottom, but the stock keeps bleeding lower because the institutions are still quietly distributing their shares.
Right.
Our technical sources even point to short-term outlooks, predicting a dip as low as $364.84 by April 16th.
Just a couple days from now. So if the charts suggest the big money might be walking for the exits, let's look at the actual institutional and insider data.
Always follow the money.
Exactly. Who is actually buying and selling right now?
Well, the institutional action is incredibly polarized, which only adds to the volatility.
Right.
On one hand, you have long-only funds showing real risk aversion. Bank picked it and C Europe AG recently trimmed its stake by 2%.
Okay.
Beacon Investment Advisory also sold off shares.
And just for context for you listening, long-only funds are the traditional mutual funds and asset managers that buy and hold for years.
All right, the steady hands.
If they are trimming, it means they are actively managing risk and pulling ships off the table.
Precisely.
But on the flip side of that, the options data shows unusually heavy bullish call buying just yesterday and today, April 13th and 14th.
Which highlights the divide perfectly. The institutional asset managers are cautious, but the options traders who use leverage to make short-term bets on volatility, they're gambling massive amounts of capital on a sudden bounce.
But let's look past the Wall Street funds for a second and look at the people inside the actual building in Redmond.
The insiders.
The executives. Because insider selling from the top has been highly visible.
Oh, yeah.
Executive Vice President Kathleen Hogan sold over $5 million worth of stock at $409.52 just last month in March 2026.
Yeah, and the most publicized move was CEO Satya Nadella.
Oh, right.
He famously sold roughly $75 million worth of shares at $504.78 back in September 2025.
I mean, he essentially top-ticked the entire market.
He really did. Now, it is important to add the nuance here that insider sales like Nadella's or Hogan's are often executed via 10b5-1 trading plans.
Right, the scheduled sale.
Exactly. They schedule the sales months in advance to avoid any accusations of trading on insider information. So we can't automatically assume they're sitting at their desks actively trying to time the top.
Look, I hear that, but legally scheduled or not, cashing out $75 million at the absolute peak still means the CEO decided, months in advance, that $500 was a very good place to take massive chips off the table.
That's true.
The optics of that still spook investors.
It definitely doesn't look great when the stock is sliding.
But to make things even more confusing, Director John Stanton stepped in and bought $1.98 million worth of shares at $397.35 in February 2026.
And that purchase is a crucial piece of the puzzle.
Right.
Because executives might sell stock for a dozen reasons. Buying a new estate, diversifying their portfolio, paying tax bills.
Sure.
But they only buy stock with their own money for one reason.
They believe the price is going to go up.
Exactly.
So we have the CEO taking historic profits near $500 and a director putting almost $2 million of his own cash on the line near $397. It's just a complete tug of war.
And that internal tug-of-war directly mirrors the fundamental debate tearing Wall Street apart right now regarding Microsoft's entire artificial intelligence strategy.
The core debate.
Right. We are watching a collision between the bears who see an AI value trap and the bulls who see an undervalued gem.
Let's start with the bear case because it is getting incredibly loud.
It is.
We touched on the fear of margin compression from the massive capital expenditures, but the bears are also pointing to the revenue side, arguing that enterprise adoption of AI has dramatically slowed down.
Yeah, the honeymoon phase is over.
Right.
During the initial hype cycle, every Fortune 500 company bought AI subscriptions just to experiment. But now CFOs are looking at those expensive software licenses and asking for hard data on ROI.
The return on investment.
Exactly. If the productivity gains don't justify the cost, those subscriptions won't be renewed.
But the most alarming part of the bear case, the thing that I think is truly driving the institutional fear here, is the strategic friction with OpenAI.
This is massive.
There are widespread reports right now that OpenAI is actively pivoting toward Amazon and AWS, threatening Microsoft's exclusive reliance on that partnership.
And this is where the narrative shifts from a software problem to an existential infrastructure problem.
So it really is, because the aha moment for me was realizing that Microsoft isn't just a software company anymore.
No, not at all.
They essentially became a highly specialized commercial real estate developer for AI.
That's exactly what they did.
They built massive multi-billion-dollar data centers tailored exactly to OpenAI's specific computing needs. And they fronted all the cash for the construction.
Yeah.
Now, right after moving in, the anchor tenant is reportedly taking meetings with Amazon across the street. I mean, how does a lock-in like that unravel?
It unravels because compute power is the new oil. And OpenAI realizes that being entirely dependent on one supplier, Microsoft, is a massive strategic vulnerability.
Makes total sense for them.
Right. If OpenAI diversifies its cloud providers to reduce its reliance on Azure, Microsoft is suddenly left holding the bag on hundreds of billions of dollars tied up in infrastructure. If OpenAI shifts workloads to AWS, how does Microsoft monetize those empty servers?
That is a terrifying thought for a shareholder. You build the factory for a specific client, and the client just walks.
Exactly.
But we have to represent the other side of the aisle here, right? Because the bull case is still backed by some of the biggest names in finance.
And the bull case is grounded in actual verifiable revenue.
Right. I mean, you look at Azure, a $75 billion run rate growing at over 30% is an undeniable cash-generating machine.
You can't argue with those numbers.
No. The bulls argue that the massive AI infrastructure investments are not fundamental flaws, they're just constructive timing delays.
Basically, you have to build the roads before the cars can drive on them.
Exactly.
And the bulls point out that those roads, the servers and data centers, have a long, useful life. Microsoft is building the foundational infrastructure for the next decade of the digital economy.
Right.
Even if OpenAI is no longer the exclusive tenant, thousands of other enterprise clients will eventually need that compute power.
And analysts at Bernstein seem fully aligned with that view. They currently rate Microsoft as an outperform with a massive $641 price target.
Yeah.
And analysts over at Seeking Alpha are explicitly calling the current price a quote-unquote rare discount.
Look, if the enterprise adoption is just experiencing a temporary digestion period and the CapEx eventually translates into high-margin recurring revenue, the bulls are entirely right.
So buying Microsoft at $384 will look like the trade of the decade. So synthesizing all of this for you listening, we've got the bull case looking at a $640 gem and the bear case looking at a margin-compressed value trap. It feels like your perspective on Microsoft right now entirely depends on your investment time frame.
Time frame dictates everything in this current setup.
Okay, break that down.
If you are playing the short term, the sources are practically screaming caution. The environment is highly volatile. We have negative technical signals, persistent downward momentum, a neutral RSI that hasn't found a floor.
And those technical analysts predicting dips into the $360 range over the coming days.
Right. But if you zoom out to a medium or long-term horizon, the consensus rating remains a moderate buy.
Because we are seeing price targets ranging from $556 from BNP Paribas all the way to $800+ by year-end 2026.
However, and this is a big however, there's a massive condition attached to those $800 targets.
Which is?
They're entirely contingent on AI monetization materializing soon. The market is exhausted by the promise of AI. They demand the profits of AI.
Which brings us to the ultimate catalyst, right?
Yeah.
The single event that is going to force the market's hand and likely decide the direction of this stock for the rest of the year.
Yes.
Q3 fiscal year 2026 earnings are fast approaching on April 29th, 2026.
Just about 2 weeks away from today.
So what are the magic words that move a $2.85 trillion stock? What are the analysts going to be listening for on that call?
Every single analyst on Wall Street will be listening for 2 specific things.
Okay.
First, guidance on future CapEx spending. They want to hear words like stabilization or leveling off.
So is the spending peaking, or is Microsoft going to have to keep digging deeper into its pockets to keep up with compute demand?
Exactly. And second, they need clarity on the status of the OpenAI relationship. Satya Nadella is going to have to address the Amazon AWS rumors head-on.
Well, so no dodging it.
No dodging. The tone of his voice and the confidence of his answer might literally swing the market cap by $100 billion in after-hours trading.
It is just incredible to think about $100 billion of wealth hanging on the subtle tone of an earnings call answer.
It's wild.
So, to wrap this all up, the tension we explored today is simply unprecedented.
Truly.
On one side, we have a historically profitable Titan generating $128.5 billion in operating income, yet the stock is trading near 11-month lows.
And we have technical charts flashing bright red warning signs to retail traders about catching a falling knife.
Right. And above it all, we have a multi-trillion-dollar AI narrative hanging in the balance, just waiting to see if the anchor tenant is going to stay in the custom-built data center.
It is the absolute definition of a high-stakes crossroads. The fundamentals and the technicals are telling 2 entirely different stories.
They really are. And if you found this breakdown helpful and want to keep untangling these complex market narratives with us, please take a second to like the video and subscribe to our YouTube channel.
And definitely drop your thoughts below.
Yes, leaving your comments and feedback is compulsory to keep this debate going. Are you buying this dip, or are you staying far away until after the April 29th earnings? Let us know what you are seeing out there.
The data is mixed, so your read on the psychology of the market is just as vital.
Because I want to leave you with a final provocative thought to mull over. We've talked a lot about whether Microsoft's massive bet on AI infrastructure might just be a few quarters too early, and if so, maybe this is a generational discount.
Right.
But what if there is a bigger structural shift happening?
Like what?
Well, as this AI arms race evolves and the costs just skyrocket, has the true power fundamentally shifted away from the software giants who build the applications and toward the pure underlying infrastructure and energy providers who just sell the electricity and the chips?
That's a fascinating angle.
Right. If the gold rush is getting too expensive for the miners, maybe the real generational wealth is in owning the company that sells the shovels. Keep questioning the consensus, keep digging into the data, and we will see you on the next deep dive.